Hello and welcome to yet another live session within TechnoFunda Investing YouTube channel, and this is a powerful investor awareness video which we are going to share. So if you are somebody who is buying mutual funds and if you are doing SIPs and if you don't have any strategy around SIPs, if you don't know when to buy, if you don't know when to sell your mutual funds and what kind of mutual funds to buy, let me tell you, you are in a big problem. So if you have the same issues, like if you don't know which kind of mutual fund to buy because there are thousands of mutual funds out there, if you don't know when to sell and what to do with your SIPs, this is the video for you. So let's get in. I have very important 5 mistakes which I want to share with you, which most of the 90% plus investors make, and I will tell you how to avoid these mistakes. So let's get in. Let's go deeper into this particular concept. Alright, so I'll go with the mind map first. So we will learn about these two prominent concepts. One is, passive versus active. A lot of people might have heard the slogan mutual fund Sahi hai, and it is of course a right slogan for somebody who wants to sell mutual funds. But we will try to analyze and dissect whether this is like totally true or there are loopholes and what are the drawbacks around buying mutual funds. So we will discuss about are mutual funds the right options for everyone, and I'll give my perspective around it. क्या mutual fund सही में सही है? Second, I'll give you a perspective in terms of investing in index ETFs versus direct investing, and why should you consider direct investing. So I'll give you perspective around that. And second powerful concept which we are going to learn is the goals. So how you can aim for returns, which is aiming for index beating returns or even higher. Is it possible to beat index returns? And what kind of return you should aim for. So all these things we are going to discuss in this journey. Now let me ask you first question. What does your mind tell you when you want to make a lot of money? Your mind will first analyze any asset class, which you are investing right now. So what are the prominent asset class which you are investing right now? Just type in the comment box. It could be FDs, it could be real estate, it could be bond. And you might be wondering how to beat my bond returns, right? If I'm doing FD, maybe I get 7 to 8% return. That is not enough. I'm hardly beating inflation. If you consider after tax return, probably I'm not even beating inflation. If you consider bond, there are a lot of changes in terms of taxation laws that are coming in. So how to go about slightly better returns than my bonds, or how to get better returns than my real estate portfolio? Those are the questions which keeps coming in the mind of investors, and that is where the first journey of the mistake starts, which is what I called quest of higher returns. So we always want higher returns in our journey, right? We want to do more, we want to earn more, and nothing wrong about it. But what leads that to do is we want to sacrifice our FD bonds and jump into equity. And then you search for a mutual fund advisor and he says that yes, mutual fund sahi hai, you go all in, and equity gives you average 12 to 15% returns over a long period of time, which is true. But then there is a big problem, right? We forget about asset allocation. Equity is not made for everyone. Even if it is made for everyone, you cannot allocate your 100% to equity unless your risk profile allows it. Okay, so don't blindly just go into mutual funds or full on into equity without understanding about asset allocation, or totally, just don't forget about asset allocation. So don't go heavy on equity or equity mutual fund thinking that equity mutual fund sahi hai. You need to stick to your asset allocation. If this is clear, just type super clear in the comment box. So don't blindly run after equities just thinking that just because it is giving higher return, it is very good asset class. It is risky, it is volatile, it can go up and down, and that is what all of us as an investor need to know about it. Now second mistakes which a lot of people make. So first mistake which I said was lure of higher returns. So because every one of us wants higher and higher returns, we give our money to fund manager, put money into mutual fund, and those fund managers in turn put money into different securities. So of course we might get some higher return, But what we are doing in this process is taking higher risk than what we should be taking. The second very big mistake which people make is they think that, okay, I am making money into equity mutual funds, but I don't want to take risk, right? And there is an option of index funds. You can put money into Nifty 50 index, you can put money into small cap index, mid cap index, and there are a lot of funds available out there. But this is a common mistake again people make, is they think that instead of putting Nifty index fund, which is a passive index where nobody touches it, right? There is a mechanism, there is a rule which Nifty has defined, the NSE has defined to manipulate Nifty 50 or the weightage of that based on the rules. So if there are the criteria which is getting met, the changes of the weight will happen, otherwise it will not happen. Now we think that, since a lot of these fund managers are very smart, let me go for a large cap mutual fund instead of index mutual fund, so that I can get more returns and I'm also having lesser risk because I'm investing into large cap companies. Now this is again not my advice or not my opinion. This is what data says, that more than 70% of large cap mutual funds are not able to consistently beat index or benchmark returns. Okay, this is not what I am telling. This is the factual information I am sharing with all of you. Now you need to decide whether you want to blindly buy large cap funds thinking that you will get more returns by taking much lesser risk. Okay, so this is a very big mistake a lot of investors make, and I want to make you all aware so that you don't make the same mistake. The third thing which a lot of investors make is they think that if you do SIPs, right, if you keep buying monthly, you are actually avoiding risk, or you are just being smart. Okay, you are not timing the market and all those things. This is like the utter nonsense which has been shared by people who wants to sell mutual fund to us. Now see, in any securities, right, if you buy direct equity or you buy mutual fund or you buy anything in the world which has some underlying cash flow, valuations are super important. How many of you agree that valuations are super important in our investing journey? If we ignore valuation, we are just waiting for a disaster to happen, right? And if we do blindly SIPs, which means without looking at where the index is going, without looking at where our GDP is going, without looking at what valuation your underlying companies are trading, you are just waiting for a disaster to happen. Okay. Now you might say, but Vivek, what is the way? I don't know how to, even think about valuation. I am like a blind investor who doesn't know anything about equity. The answer to that is, you can always use very simple tools. There are so many simple tools which are available, which you can use in your investing journey to simplify and understand whether you are buying a right kind of security at a right valuation. And I've discussed in depth what are these kind of tools which you can leverage in my YouTube video also. You can go and search top 5 stock market analysis tools, Vivek Mashrani, and you will get this video. So go and check this out, but I'll just give you an example of how you can actually use simple tools like technical analysis to sell at a peak of overvaluation and buy at an undervalued price. Okay, so just check this out. Just check what we have done over here. Okay, so just let me show it over here. So if you see, this was a big trend. Like after COVID, there was a big rally, and last year in December, Nifty made a top and it was probably overvalued at that point of time. Now, if you see the indicator which I have built, which is called Shaktiman indicator, which I share with some of my community members who are part of my community and who qualify for getting this, you can see that it is giving you buy signal and you are in that particular uptrend and you are making money. But as soon as it is making a top and it is overvalued, slowly it is starting to give you signal to exit. So in this entire period where it was probably highly overvalued, it did not give you buy signal. And again, when it became undervalued and the valuation cooled off and the trend started picking up, re-rating started picking up, it let you enter and it let you, buy the underlying stocks, or you can use as a Nifty index funds or your mutual fund. Now the best part is, if you would have done SIPs, right, you would not have made any returns for this entire year, because Nifty was flat for almost this entire period, right? But if you would have sold when the overvaluation was there, and if you would have bought at an undervaluation, you would have made decent money out of it. So if you think that you should not sell your mutual funds, or you should blindly keep on doing SIPs without paying attention to valuation, you are just making money for your mutual fund brokers or mutual fund distributors. Okay, so please don't do that mistake. Another example I want to give you is of Nasdaq 100, right? So just after COVID, it went into uptrend, and just by using these kind of simple tools, one could have stayed inside the game. And when there was overvaluation that happened, it was almost at a 16,700, the sell signal got triggered, and it went all the way around to 10,700, which means almost 30 to 35% of correction. And pretty much if you are doing SIP, you might not have made any money during last 2 years, despite this kind of big uptrend that would have happened. So prudent thing is, when there is again overvaluation, you can sell your mutual funds or stocks, and you can always re-enter at a slightly undervalued price. This is what is called value investing. But when people buy mutual fund, they forget about, value investing. Now you might think that, Vivek, but hey, all these fund managers are very, very smart. They know what valuation are, what is overvaluation, what is undervaluation. They might have studied in a good college and they might be qualified. Absolutely yes, but they have big constraint. What is the constraint they have is that when the money flows, right, a lot of people want to buy mutual funds when there is euphoria, when there is overvaluation, when market is going up, everybody wants to participate. But when it is undervalued, not many people want to buy mutual funds. And that is the reason, because the money is coming in to the mutual fund, even at a higher valuation, they still need to buy securities and put that into their funds. They can hardly keep anything as a cash. If you see any mutual fund, I have at least not seen more than 5 to 10% cash holding in most of the mutual funds, because they undergo this big constraint. So despite that fund manager knowing that this mutual fund is overvalued, they still are helpless and they need to deploy the fund at that particular valuation. If this was bulb on, just type bulb on in the comment box. Yeah. So my request to all of you is, don't blindly do SIPs without understanding the overall valuation at which you are putting funds. That will save you a lot of hassle, and it will make you more money than you would have made when you are blindly investing at a overvalued market conditions. Awesome. So next, let's go to one more very powerful concept which most investors miss, and they make this as a mistake. So let me share the screen and let's go to the next point. Awesome. And some of you are asking how to make these kind of systems, like how to build a mechanism where we can exit overvalued stock, and how we can enter undervalued stock. How many of you want to learn this system? Just type me in the comment box. So I'll share a link which all of you can use to learn more about this and get a deeper understanding of how to build system. Okay, this is like the session you can attend. You can also check in the description. You can go to technofunda.co/webinar, and I'm going to share with you the entire strategy, how you can create your own buying, adding, selling system, and how you can actually get out when the overvaluation is there, and how you can get in when there is things which are undervalued. So please go and register there. I also shared the link in the description if you are watching from YouTube. If you are not yet subscribed on my YouTube channel, you can go and subscribe it. This is like a simple framework which I have used for initiating, adding and exiting your position. And this is also possible to use when you are using your direct equities as well. Awesome. So that is the journey what you are going through. Now let me share with you the fourth mistake with a lot of people who invest into mutual fund they do. They don't think about underlying cost. Now when you are buying a regular mutual fund, do you know how much cost you incur? Any idea about how much cost you incur? Just put in the comment box if you are aware. A lot of people, when they buy the mutual fund, they don't even monitor their returns or monitor their expense ratio and all those things. But if you know how much is the cost or expense ratio of the mutual fund which you are having, just type in the comment box. Yes, some of you are saying 1%, some of you are saying 1.5%, some of you are saying 2%. Awesome, I think you are all on track. So anywhere between 1 to 2%, that includes your underlying expense ratio. If you are buying regular mutual fund, there is some bit of distribution fees also that is involved, so that jacks up the expense ratio. And there are stamp duties and various other small expenses which add up. And these are all recurring expenses. So every single year that get charged from your returns. Yes, that is true. And I'll give you the math of what it does for you in your investing journey. So say for example, you have put in 100 rupees of funds. Okay, so you have put in 100 rupees in your SIP and it gives you 10% return in that particular year, right? So your 100 rupees has become 110 rupees. Now assuming that it is 2% of the overall cost which you are incurring as an expense while retaining this mutual fund, how much cost you are incurring? And by the way, this entire cost is in your, based on your AUM or the money which you have put in. Okay, so this 2% is not 2% of return. This 2% is 2% of the entire money which you have put in. So essentially you are giving 2 rupees from this 100 rupees as a 2% expense ratio. And that means out of the 10 rupees of profit which you did, right, your profit is 110 minus 10, you are paying 2 rupees to your mutual funds. That means if you just divide 2 by 10, you have given 10% of your returns to the mutual fund. Now you might say, Vivek, but this is fine, they are making money for you, right? Then why not to give 20% of my money to them? Now here is the catch. On an average, Nifty returns are 10 to 12%, but it is on a CAGR basis. There are years when your portfolio will fall also, you will not make any returns, or you might even make negative returns. And still you have to pay this expense ratio to mutual funds. So based on the expense ratio, whether it is 0.5% or 1% or 2%, you incur a lot of cost. Right? So some people say that, okay, I don't want to go with PMS, I don't want to learn equity investing myself. Mutual fund sahi hai, I am incurring very low cost, there is a lot of less hassle because I am doing SIPs. But technically if you understand the cost structure of these mutual funds, it is not like a low cost in my view. You are still incurring significant cost compared to the kind of returns you are getting. Okay, so this is very, very important. And this is of course excluding some of the low cost index funds and some of the passive funds which are there. So I'm not generalizing it, but you need to basically be aware about what you are giving out to mutual fund, and this is the recurring compounding which you do. Now versus that, a lot of people don't learn about direct investing. They feel that I am spending so much of time, I'm spending so much of energy. Let me tell you, this is a big myth that direct investing is so difficult. Let me tell you why it is so wrong notion which people have. First, if you are really putting money into large cap funds, you are essentially putting money into all these HDFC, Infosys, TCS of the world. You open any large cap fund and you will see predominantly the exposure is to these all well-known companies like HDFC Bank or ICICI Bank or TCS or Infosys. Now, the simplest thing which you can do is you can go to their portfolio and you can see what are their top holdings. You can simply replicate it. That is the simplest thing which you can do. And I've shared a link in the description in the chat box also, where I've demonstrated the entire template how you can actually replicate this thing and build your own portfolio. Second, when you buy these kind of companies in index funds, there are a lot of companies which are cyclical. So they go up much higher and they come down much faster. And there again you can remove those cyclicals by having basic understanding of technical analysis and even basic understanding of some of the fundamental analysis. I cover this in depth in one of my module of core portfolio blueprint, how you can in a simple way identify companies which are cyclical and which are non-cyclical. Okay, so once that understanding is there, you can actually avoid a lot of cyclicity and lot of drawdowns from your direct stock investing portfolio. And if you do your investing directly, the best thing is you learn on the way. You can learn about more and more businesses, you can learn about more and more different companies, and you can apply that in your job, in your business, and you can be better as a entrepreneur also, as a working professional also. Okay, so that is another advantage on the top of it which you get it. And you can aim for at least 5 to 10% outperformance, right? So when you select any mutual fund, they are super conservative and they have a lot of constraints. They cannot buy all the stocks with all the kind of market cap. And as a retail investor, you can build your own system, you can enter and exit very quickly, you can rank your stock, you can do so many things which can make your portfolio more efficient, and you can aim for generating some more alpha around it. Now you might say, Vivek, but क्या फर्क पड़ता है 2-3% ऊपर नीचे हो गया तो क्या फर्क पड़ता है, right? Now let me show you a calculator from Grow which they give. Now say you get more like an index kind of return. Say your mutual fund is outperforming index. Say on an average index is giving 12 to 15% return. Say your fund gave you 13% return and you held it for 20 years, you did SIP for 20 years and you are getting end outcome of say 2.86 crore. Now, even if you outperform by say 6 to 7%, which is pretty much possible, and the next mistake I'll tell you that, say you do 20% over 20 years. Instead of 2.8 crores, you are making whooping 7.9 crores with the exact same capital. And if you are in your 20s, 30s, 40s, you easily have that kind of runway where you can invest for 20, 30 more years. So the thought process is, if you invest directly, you can do much better by understanding it. And the best thing is, once you learn how to invest, that is a permanent knowledge. You don't need to depend on anybody else throughout your life. Okay. So this is a very, very powerful thing which you should think about. And fifth, big mistake. Please don't do this mistake, is buying mutual funds based on past return. A lot of people just check what is the past top performing mutual fund and they blindly buy into it without understanding what they are getting into, which sector they are investing, what are their top holdings. Please don't do this mistake. Like even SEBI has a disclaimer which they make it compulsory for all the intermediaries that past returns do not guarantee future returns. So if you do that mistake, you are in for a big surprise, because a lot of mutual funds are not able to consistently make returns. Some who perform very well, they don't perform in the next cycle. And there are different strategies which work at a different point in time in different market condition. So please don't buy mutual fund blindly based on past returns. Your mutual fund advisors will always show you all these kind of things, but don't get lured by that. Another bigger problem is, if say that fund manager is really good, that fund manager is really sharp, that company's selection is very good, if a lot of people start chasing that mutual fund, which generally is the case that happens, the fund size will become bigger and bigger. And because of that, there is very few companies or the universe of companies where they can invest. Because say if the fund is say 50,000 crore AUM and there is a 1,000 crore market cap company which is really undervalued, they cannot simply buy it because of sheer liquidity. So the kind of companies they can choose from, the universe gets smaller and smaller. So even if the fund manager is smart, just because of the sheer increase in the size of that fund, there are a lot of constraints which that fund will face, which as a retail investor we don't face. So that is an inherent advantage we get in. So basically, don't get lured by the past returns, don't jump in. And another point which I made is, think about the higher cost, which is killing your retirement, and on a longer term basis, it can really reduce your returns if you think about it. So please learn direct investing if you can, if you have bandwidth. And I've also shared a very powerful template which you can use to find out all these core compounding companies, and you can compound much better in your investing journey if you are able to do it in a right way. Okay, so please go through it. And very important, another aspect which these mutual funds face, and rightly so, is that if there is a winner in their portfolio, right? If they bought 5% of one company and it becomes 5x, say it becomes 25% of their entire portfolio, assuming nothing else has moved, they need to trim their allocation due to sheer compliances which are there, which is good because it's a big fund which they are managing and they need to make understanding about the larger interest. But as an individual investor, if you are a slightly more high risk seeker, and if you are really confident and having conviction about the company, you can actually ride those winners, make it a bigger part of your portfolio, and you can exponentially grow your portfolio returns by independently building conviction around the company. So all these points, if these were bulb on and you liked this entire session, just type bulb on in the comment box, and let's stay connected with more and more such insightful videos. I'm Vivek Mashrani signing off. If you are not following me on Twitter, go to Vivek Mashrani Vivek. This is my Twitter handle. Let's stay connected. And all these things are just the common mistakes which I have observed people doing it around me. This is no way investment advice. I would highly recommend all of you to consult your financial advisor to get into right kind of mutual fund. This is just my view in terms of what I observe around a lot of retail investors whom I've connected and socialized, and this is what I've gathered as a summary of top 5 mistakes which they have been doing. So thank you so much again. Take care and God bless in your investing journey. All the best.